My name's Ethan Braid. Today we're going to look at how much tax you pay on a $2 million retirement portfolio. This is going to be a very helpful retirement planning video for anyone who's trying to get an idea of what their net cash flow will be off of a $2 million retirement portfolio. I'm going to go over several different scenarios using an all IRA retirement portfolio, an all after-tax retirement portfolio, and then a blended retirement portfolio that has an IRA, an after-tax account, and a Roth IRA. After you watch this video and you look at these three different examples, you're going to have a much better idea about how you can save thousands of dollars of taxes throughout the course of your retirement. Before we get into the tax illustrations, let's quickly look at how much income we can expect from a $2 million retirement portfolio. The typical retiree is going to have a 60-40 equity to fixed balanced retirement portfolio. We can approximate that portfolio by putting $1 million to 60% into the S&P 500 ETF as SPY, where we're receiving a dividend yield of 1.26%. Then we put $800,000 into the AGG ETF, which is the aggregate bond market, where we have a dividend yield of 3.46%. Our yield on the entire portfolio will be 2.14, and we're receiving just under $43,000 in total income. Our first illustration will be for a couple over 65, married filing joint. They have a $2 million IRA account. All of their retirement portfolio is in an IRA or IRAs. This couple is receiving $60,000 of Social Security. That's a very standard amount that a married couple might receive. And they're going to be receiving that $43,000 of income. Notice that I rounded it $200 to make this illustration easy, but $43,000 of income off of their $2 million balanced portfolio. How much tax will they pay? After the standard deduction, they're going to have $41,350 of taxable income, a total tax of $4,501, effective tax rate of only 4.4% on their $103,000 of retirement income. Our second illustration is for the same couple with the same amount of Social Security, the same amount of total income, but different types of investment accounts. We have $1 million in an after-tax account, $750,000 in an IRA, and $250,000 in a Roth IRA. The investment income is going to be identical, but it's coming from different types of accounts, and therefore the taxation is going to be different. Ultimately, instead of paying $4,501, this couple is now paying $2,629. That's a savings of $1,872 per year. And over a 25-year retirement, this couple will save almost $50,000 of taxes just by changing the types of investment accounts that they've built up for their retirement. Our third illustration is for the same couple, but this time the $2 million is all in an after-tax account. No IRAs, no Roth IRAs. Look what happens to their taxes. $2,701 versus $4,501 if all of their money was in an IRA account. Why is that? $15,000 of dividends from the S&P 500 are going to be taxed at the 0% level. It makes a big difference. It's almost as good as a Roth IRA. Qualified dividends from after-tax investments really help lower your total tax bill in retirement. Now, what I've done in these illustrations is I've only focused on the actual income of the portfolio. And if you have an ETF portfolio or you have a balanced mutual fund like the Vanguard Balanced Index Fund, for example, that's a 60-40 fund, you're going to find that the total yield on the portfolio is right around that 2% mark, maybe just a little bit higher. A lot of balanced portfolios are not going to have a lot of yield right now if 60% is in the stock market, mostly represented by the S&P 500. The yield's pretty low. Most retirees are going to spend more than 2% of their retirement portfolio. That's been my experience in 25 years. So what I would say to that is, when it comes to tax planning, is just think about this. If you take more money out of your IRA than the portfolio is producing in income, you're going to have more taxes. Every dollar that comes out of an IRA is going to be taxed as ordinary income. Compare that to a Roth IRA or an after-tax brokerage account. If you spend more than the income in those two account types, then you're probably spending either principal or capital gains, and you will have a lower tax bill than if you were pulling money out of an IRA account. So to sum it all up, if you are planning to retire with $2 million in your retirement portfolio, and all of your money is in IRAs, 401ks, 403bs, i.e. qualified plans, then you will be in the highest tax scenario. Every dollar that comes out of those plans will be taxed as ordinary income. So if you want to save yourself thousands of dollars of taxes throughout the course of your retirement, the best thing that you can do is build up money in Roth IRAs and after-tax investment accounts. With an after-tax investment account, it's possible to receive some dividends, if they're qualified, at the 0% taxation level, and others at a very low taxation level. With a Roth IRA, all of your income is going to be tax-free. So when you take these steps in planning your retirement, what I call tax diversification strategies, you'll have a lot more money to spend over the course of your retirement. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.